The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
Hi, a warm welcome to us, to the program, I should say. This is The Call. 10 companies picked by you, 2 expert guests, 1 hour, Friday the 1st of July. I'm Nadine Blaney, and we have Junbei Liu from Tribeca Investment Partners here with me in studio. Adam Dawes from Shawn Partners as well. I'm so looking forward to this, guys. It's so good to see you again.
Happy New Year.
Thank you.
Absolutely. We're so looking forward to this one.
Absolutely.
Is it going to be a happy New Year, you think, Junbei, for equity investors?
Oh, absolutely. This is going to be a much better year compared to the last year. Certainly last 6 months, it will be much better 6 months.
We were talking about this, is that the first half of the financial year was great. Returns are fantastic. January 4th, everything looked great. And then all of a sudden it all started to go...
Pear-shaped.
That's a better word for it. Pear-shaped, and then continued the volatility, which is really unnerved.
And what's incredible is that it's like a domino effect, right? So in January, everyone sold all the tech growth companies, and then the next one was the banks, and next one was builders, retailers, and then there was the banks, and then there's the resources at the end of it. So it's just incredible.
Well, that's our market, isn't it? That's pretty much that's all our stocks.
Exactly,
market,
everything got sold off.
Yeah, so you're thinking there's opportunities.
Oh, absolutely. So now that if you look at the rebase across all of the sectors, valuation certainly supports a lot.
There's definitely good value out there. I'm still a little bit cautious about what's going to happen in the US, which is going to have a flow-on effect to what's going to happen here in Australia. And I do think UBS put a really good note out the other day about earnings potentially coming back about 20%. The price has come down, but the earnings haven't. So we might see a little bit of a rebase. We've seen confession session at the moment. There's been a lot of the gold stocks have been hit pretty hard because their production numbers aren't up to scratch. Those kinds of things. So it's going to be interesting, but yeah, I pray it's going to be a better year than last year, that's for sure.
Now, I was thinking just in that, when it comes to earnings season, what do you think we're going to get? We're going to get a lot of insights from CEOs into how they view the macro environment.
Oh, absolutely. So there's a few themes that will play out. So one is the demand environment, and I think demand environment is still pretty good. The consumer sector might experience somewhat of a weakness, as we have seen. Consumer confidence is all-time low.
Consumer discretionary.
Discretionary. So, however, I think the demand environment is pretty good, and pricing increases have gone through. All your staples, Woolies, and other people have talked through. There's no issue with that. Costs will go higher. So you will see the market leaders, the stronger players will be able to pass that through, and they will do well. Now, the good thing about market being derated in the last 6 months, and in the particularly last month, and heading into this reporting season, is that if you get the earnings right, because every company got sold off, every single sector, including oil companies. So any company can find that actually can surprise on the upside in terms of earnings. Share price will go up. Go up quite a bit by in August this year.
That's a feature of this confession season as well. I mean, when you disappoint, you're marked down 20, 30, percent.
Little misses as well.
Little misses. So you're thinking that little beats could result in these really big upticks?
Well, it's always the way, isn't it? That and it's got to be a little bit of a flavour of the month too. So some stocks can beat, and the market just sort of pushes them away and sort of says, look, I'm not that interested in what's going on. But yeah, definitely a beat would be fantastic. I mean, I had read through Metcash's result the other day. Their hardware business is over now 20% of their revenue, and that was actually quite a good number. Can I read that through to Bunnings in Wesfarmers? Maybe. So, there might be some bright spots in there, but I do feel that earnings are going to get rebased lower for most of the market.
Oh my goodness, I forgot what we're here to do. Let's get across the companies that we will be talking about. United Malt Group, Oz Minerals, that'll be an interesting one. Scali, Clinuvel, and ALS. But the stock of the day is Brambles. So you've most likely heard that it has decided not to provide suppliers to Costco with a plastic pallet pool. So it's not going to contribute to that. It says that it does still have a strong relationship with Costco in the US and its suppliers. However, not able to agree on commercial terms and price premiums. It does not expect a shortage of demand for its pallet stateside and expects to see continued improvement in the underlying profit through to FY25. So, do our experts find Brambles palatable? Dad joke there. Okay. What do you think? I mean, if you're an existing shareholder, are you breathing a sigh of relief? Is this prudent capital management at this time, or are they missing out on a huge opportunity?
Is it because it's plastic that they're not?
Part of the reasoning I was told is that the input cost prices for doing it makes it uneconomic.
Right. but then treated wood for their other pallets is pretty carcinogenic, and they're really heavy, and
lumber's been so expensive as well.
Expensive. So yeah, I don't know.
Well, I'm not going to put the case for Brambles forward. I just want
So
to
you
know
want
if
me
you'd
to do
buy,
that?
hold, or sell it.
Okay. Look, if you to your original question, if you hold it, I would definitely hold it. I think it was under takeover, but then wasn't under takeover, so they stepped away. So I think that there is definite interest in the stock. Brambles, one of those stocks that really hasn't done much for the last 10 years, and if you look at the chart, it's just moved sideways. It really hasn't done much. So I think over the longer period, Brambles has been a good quality business, always in the top 20, top 50 stocks, so it always has that sort of institutional flow. But for me, it's not one that I invest in. So if you hold it, hold it. If no fresh capital at the moment, I think there's better places to be.
Junbei.
Yeah, I'm probably sitting there similarly. I'm currently not investing in Bramble, I think, but if you hold it, you hold it. So we should experience a bit of relief rally on the back of that, because people worry about all these investment that's going into it, all the ESG and all of these sort of things. And then by them stepping away, is actually you will see 5% or so sort of uplift, or 5 to 10% uplift. But that's about it. But in terms of fundamental, lumber cost is a big cost for these guys, and that has since come back 50% or so for this business. So result will be pretty good. It's pretty defensive. Share price performed well relative to a weak market. So it's kind of just thereabouts. People tend to pair this company with Amcor, and relatively I prefer Amcor compared to Bramble, even though Bramble, on 17 times, Amcor somewhat similar, but Amcor has had far more, a lot of cost headwind in the last 6 months, and now they're all coming off. So relatively, I think it's probably a bit more interesting compared to Brambles.
Yeah. I agree. Amcor's better business.
Got it. All right, guys. Thank you. That's the stock of the day. Can we go to United Malt Group? This one is for Ashley. Ashley, I do hope you're watching. Remember, not financial advice, information only. You'll have to do your own research or get financial advice. United Malt Group. So its first half profit was about $10 million. It reiterated its FY22 guidance when it reported back in May, remained confident in the outlook after FY22. Are you confident that it will be able to continue to perform?
Look, it's I'm not sure, because this company have disappointed quite a bit. I am not 100% confident, but the level of comfort does come from the business has been impacted a lot by the COVID-related disruptions and shutdown of all these breweries, right, really. And it is a reopening trade, and this company, the valuation is so cheap, so it certainly provides quite a lot of support. Now, there might be start and stop in terms of, recovery in earnings. It is just sitting that lower end, sort of, the trading band, it looks, it's got valuation support. It's not something I would put my money into, but, for a valuation play, it's probably more of a, weak buy in that business.
So it's cheap.
It's cheap.
So
it's
yeah,
cheap.
that's if that's all it has going for it, would you be buying?
No, this is not one that I would look at going forward as well. They've had a benefit from the COVID, but also then from the Russia-Ukraine war. There's a lot of malt that's been produced out of Ukraine that is getting pushed through to Australia. This was a spin-off from Grain Corp, correct? Yeah. So it usually does well after it's been left out from the parent, but this one doesn't look like it's actually done quite well. I think if I'm going to be in an ag stock, I prefer Elders as my pick. More diversified, got lots of other stuff going for it, and you're not so beheld to the malt price, the grain price, these kinds of prices, or the commodity price that it's in. So more diversification, Elders is a better play for me in that space. So it would be a no from me for United Malt Group.
Got it. Now, let's get on to Oz Minerals, because we have seen copper prices being absolutely hammered, as it often acts as a bellwether for economic growth around the world. But it is also used in the whole decarbonization push. So Scott saying, what about the pullback that we've seen in Oz Minerals? Also saw a bit of a downgrade on production guidance. He reckons that maybe those issues are transitory rather than structural. So again, asking, is this a good price to get in to Oz Minerals?
Transitory, hey? Remember that word? Huh?
Very unfashionable.
Very
now,
unfashionable
isn't it?
because it wasn't transitory. It's already the inflation's staying with us. So, that word transitory, I don't know about. Was it Scott, was it? The gentleman?
Yes, Scott.
So yeah, don't use that word, Scott. I think we've got to try something else. But anyway, I think Oz Minerals, with the downgrade, as most resource companies have come out and confessed that probably it's not going to be as good as what they did last time. I think that's put into the price. I'm going to say it's a buy. I think Oz Minerals is a great business. The structure of it's fantastic. The management know exactly what they're doing. They are very, very good at what they do. They've just taken on another mine as well, which is going to extend their mine life. I'm really comfortable. I think the price has come down enough now to take advantage of that sort of negative underproduction. So I'd stay with a buy on this one.
Jimmy, I'm going to disagree because I've been speaking with a number of metals and mining analysts who say the next 12 to 18 months still not looking good for the price of copper. So potentially you could get Oz Minerals at cheaper. I mean, it's not down to where it was, pre-pandemic.
I kind of agree on that basis because because of COVID, we had a lot of supply disruptions while demand was very strong because of electrification and everything else. And China was, powering away last couple of years. So, copper price actually has been well supported. In the next 6 to 12 months, the supply coming on is quite meaningful. So my overall view of the copper is probably more neutral to negative, just simply because one is supply coming on and two is that the demand is falling off. Now, demand falling off, I think people is overplaying at the moment, the whole commodity complex being sold off. China is reopening, so you want to be re-leveraged into that space. We see great signs of increased stimulus and all of these things coming through, and the borders are opening and reduced in vaccination, all of that sort of things are happening in China. You want to be leveraged to it, and commodity is a great place to be. And I think all of these names that will be well supported in the next 6 months, especially actually heading into the reporting season now that production is out of the way. So copper to me is something you want to buy on the dip, and Oz Mineral is the best stock to be really buying. It's the highest quality. It used to be the most expensive in the world. Share price come off quite a bit, but maybe there's a bit more short-term pain in the next few months just when things come back up. But you know what, you buy the copper really for the longer term. So for me it's a buy. But you do buy it for on a 12-month view or so.
So medium term.
And another thing is that I think this will be quite apparent in the next few weeks, like you said, the confession season, especially across the resources companies. Most of them will have production downgrades simply because there's disruptions across the supply chain. It's been very challenging. We've seen that in the last reporting season for these guys, and then we'll see it again. We'll start seeing it through the gold, and we'll see it through these guys. Almost every one of them will have downgrade to expectations just because of high cost. And on the day they'll get sold off. Generally, they recover if it's a good company. Just timing.
Look, if we've got time at the end, I might ask you a quick question about gold because a lot of viewers are wanting to know what's going on and if there's bargains there.
Definitely.
Okay, let's though continue with what we're doing. Nick Scali, NCK, this is for Marcus. So again, guys, many people I've been speaking to have been saying they wouldn't touch a discretionary retailer with a 10-foot pole. Would you?
I think it's really tough for discretionary retailers. Look, they have such a great time because of the stimulus and people trapped at home. They were spending a lot of money. And housing is one of the areas people have spent a lot on sofas and furniture. So these guys all have done very well, even though they will tell you the pipeline is enormous because they couldn't supply literally to all the demand, but pipeline can disappear quite quickly. So I think that's the challenging environment for the especially housing related retailer. I think someone just initiated, I think Barrenjoey just initiated with a buy. I think the title is exactly right. It says, straw hat in the winter. And this is what this company is at the moment. It just seems to be the wrong environment to hold this. Earnings is going to be quite challenging over the next few years, really. It's a great company. It's got rollout potential. It's got all of that. It's just, it's going to be very challenging. Now, remember 12 months ago, we were talking about e-commerce businesses. Remember we were saying, it's going to go through challenging periods. Let's see how they respond because competition will pick up and all of that. And look at the share price. All of them are so far lower than what we expected at the time, just because, when earning keeps getting downgraded and when competition picks up across retail space, we just don't know how bad it can get because it's a fixed cost business, right? So I think just a challenging environment for this business. I wouldn't be touching them at the moment.
Yeah, I agree. I mean, I think I was on the show maybe 3 months ago, and we were talking about Nick Scali. The question came up and it was about $10. And I said, look, I'm getting out for my clients. I think, and now at $8, I still think that there's further downside to go. Albeit Nick Scali's got one of the best inventory management systems in Australia. These guys know how to manage their inventory. It takes you 6 months to get a couch because it's got to get made. It's not sitting in a showroom. They've got some really good structure behind it. but that discretionary spend is just going to get weaker and weaker, and this is perfectly in that space. The only one that I do like is Universal, UNI. Have you seen that one, Tribeca?
I've seen that one. My kids shop at the UNI.
Right.
And,
So that one is future-proof from interest rate rises, because
they're living with mum and dad.
Millennials don't worry about mortgages or
Share
interest
price
rates.
has been under pressure, though.
Correct.
And it did have a downgrade, didn't it?
look, I think because of the disruption,
But
then it came back. Yeah, they came back.
And it's gone lower than its IPO price, and now just gone back up again. That's a clear signal that it's something.
Yeah.
So I think on top of that, so I like Lovisa as well. I want to throw that in because people, investors are selling the whole sector, right? And this is where you see opportunity and things you want to buy. Things the one has a reopening thematic to it. So Lovisa was hurt because there's no going out and trinkets and everything, and now events coming back and people still spending on outgoing events, restaurants, and these sort of things. So that company is well leverage, and you like Universal, it's not a mature retailer. You buy a retailer that has its own store rollout, you're going to new regions and all of that, and they will far outpace in terms of growth compared to the mature retailer. So that the cycle they will experience will be much smaller compared to the likes of JB Hi-Fi.
And likewise, the share price was under pressure, but it looks as if it's just starting to tick up as well. All right, we got a lot out of that one,
bonus
Marcus.
buys.
I know, I love my bonus buys. All right, let's get to number 4 on the list. This is Clinuvel, CUV for Talia, and she's pointed to you specifically, Junbei. What do you think of Clinuvel?
Look, many years ago, I looked into this company. I just felt it was way too expensive for its own product. And then since the share price has come back, but overall the biotech space has come back. To me, it is a business that, its product is targeting a very rare disease. And so the addressable market is quite small. And in the last few years, I think they're trying to develop into a few new areas. Actually, I'm not sure whether they hit some of those milestones yet. I don't think they have yet. So, so the overall addressable market is actually quite small for the the core product where they're good at. So to me it's harder to really justify and capitalize on the future earnings. So for me it's a little bit too hard. I know this company has very strong following, so a lot of biotech investors really love this one. But for me it's just a bit harder as a general equity investor into this one. One thing I do like in that whole space is Aroa. It's equivalent to Polynovo, smaller, cheaper, and they're not the synthetic space. They use the sheepskin to really use healing wounds and things. They actually got a lot of clinical study to support their outcome, and then they actually have a lot of contracts with hospitals already. If anything, actually they far advanced than compared to the Polynovo, but much smaller. So that one we do like. Share price sort of under a lot of pressure compared to similar as every other tiny microcap. But to us, this is something that on a few years view is going to do very well.
What was the name of it again?
Aroa.
Aroa. I know that one. We've talked about this before. Yeah, and interesting, just a sentiment about the biotech space. I mean, again, if these share prices are very beaten up, now might be the opportunity because the cycle will turn.
Yeah, that's right. So you tend to, so this is a funny observation of the market over the last few decades, is that, when CSL does well, the little biotech tend to follow over time. In the US, they run a very different cycle. So when big pharmas do well, then biotech do really well because big pharma go out and buy them out, and then the valuation rallies. And then whereas here, they tend to follow what CSL's doing, and CSL clearly has been under pressure because it's expensive and because earnings was hurt by the COVID lockdown. And now on the next 12 months or 12 to couple of years, is things looking very, very strong for CSL, and I do think that following the juniors will certainly follow that follow suits. But to be very careful, invest across biotech, especially early stage biotech. You've got to know your stuff. Yeah,
it always comes with that caveat. So learning from history often echoes, doesn't it?
It does, and with this share price down about 50%. Over the last sort of year or so, it's been a tough one for these guys. So for me, I don't understand biotechs, so I don't invest in them. So that's my first thing. The second thing is that I've always been hit pretty hard with these biotechs, and that chart tells you a lot about what's actually happened with this stock. And also, it's interesting to note, a couple of months ago, we did see some non-executive directors selling some of their stock. Not that that's a bellwether for anything, but it does mean that they potentially can see a little bit more than what the market can, and was getting out of some of that stock. So for me, it's a no. I'd rather be in things that I understand, and it's just a tough space at the moment.
All right, let's get on to the next company. This is for Yaz, who's a regular viewer and listener. Hello, Yaz. You're lucky to have these two here with you today. Wondering about a view on ALS. ALQ is the ticker code. He sort of runs through what it does. It's global testing, inspection and certification. It happens across the mining. I think it started out as a mining services company, but now it's going to pharmaceutical and food testing and life science.
Yep.
This week, excuse me, made a bid for HRL. So Yaz is just looking, for some guidance, I suppose, on whether this deal is a good one for ALS and what you think about the company.
Yeah, so HRL has accepted the bid, so that is accepted the takeover offer, and ALS is offering around 16 cents for it. So I think that, and the HRL board recommends that that's a great outcome for shareholders. So I think that's all sort of been sewn up and done with, which is quite good. But the testing and services business, look, it was a fantastic business. Now they've got a lot of employees, they've got a lot of overheads, there's a lot of staff that needs to go in, they've got a lot of countries around the world that they need to be in so they can get the samples from the mines to come in instead of trucking those samples halfway around the world. So they've got to be in these larger areas, and it's just a massive drag on the business. For me, it's something that I've never been really invested in, due to the fact that mining services businesses, and I guess you can class this a mining services business, but it's a lab testing business, but they always struggle because mining companies are always watching every dollar that goes out, and basically everyone says, well, there's a commodity boom on, why isn't the mining services businesses starting to move? Well, the reason is these mining businesses watch every single dollar that goes out, and they'll take off spending or they'll pull back spending for another 6 months just to make sure that their balance sheet is right. So for me, this one hasn't been a great one. It was a fantastic business, but now I'm a seller of this business. I think it's too much overheads and it's the wrong part of the cycle to be in. So I'd be careful. Interesting.
We had Morgan's upgrading it to add in the wake of that deal. Macquarie has an outperform, Credit Suisse outperform. What do you make of it?
Look, I like the deal. I think it makes sense, and I like the business as well. Yes, part of the business is mining services, essentially miner exploration linked, and they go and test all the sites before they explore. And then big exposure is actually across gold. So you need the gold price to generally do well, and then junior miners to go and spend money, and then these guys are sort of 6 to 12 month delayed after the gold price peak. So this company and that sort of business is actually doing quite well. Now, what this company has been doing the last many years is actually growing that environmental side of things. So now it's almost 50% of the business, and that side of business, you're ESG friendly and all of that, and it's extremely defensive. And then they are taking share. They're growing really fast, very rapid. That's a much higher multiple business. So now that right now share prices come off, people worry about miner. You sell the miner and then anything linked to the miner. So as a mining services being sold off quite a bit. I do like the environmental side of business, while at the same time the mineral side of business hasn't really fallen off. It's still growing quite fast. So I do like it for the time being, given it's reasonably much cheaper, and then the other defensive side of the business. And it's been often talked about as a M&A target as well, just because it's got a great business.
It's a buy.
Yeah, it's a buy.
Got it. Thank you. And that brings us to the halfway mark. So let me just recap briefly. We've got a hold for Brambles. If you're in it, stay there. But both of my guests prefer Amcor. Junbei says what you're seeing right now is a bit of a relief rally that should wash through and probably top out at about 5% to the upside. United Malt Group, it's a no for what's your name? Adam Dawes from Shaw & Partners. My apologies. It is very cheap in Junbei's view, but it's not a buy. Adam at least prefers elders in the space. It's just looking very cheap, does admit that. Okay, Oz Minerals for Scott. It is a buy from both of my guests. It's cheap right now. Adam says it's quality. Junbei agrees. Nick Scali. Look, it is not a buy. It's in a very tough spot in this cycle. But Adam's offered up Universal Stores as a bonus buy, and Junbei came to the party, and she's offered up Visa as a bonus buy, but both would not be buying Nick Scali. Clinuvel, it's a no from both of my guests. And then you've just heard ALS, it's a buy. So we've got a bit of a standoff here. It's a buy for Junbei, and it's a no for Adam Dawes. Although I think when Junbei was speaking, you were looking a little bit more convinced on that front.
Nah, not really.
Nah. Okay. Let's get to the portfolio, shall we? Thanks, Adam. And we're tracking our own high conviction fund. which is picked by our investment committee. The next episode is out next week, in fact. So this is where the portfolio stands right now. Wesfarmers, Elders, ResMed were added. Most recently, shifting the original allocations around a bit. So keep sending your requests in, and this double buy from my guest today, Oz Minerals, will be put to the investment committee next time they meet.
Grab a beer, grab a glass of wine, because this is where we just gossip.
It has been easy to get this bull market wrong.
Cheers to you.
Have a great weekend, everyone.
The Last Call is brought to you by Australian Vintage Wines. Invest in the home of Australia's premium wine brands.
We're back. Wonderful to be here with you as well. Look, we'll be talking about Woodside. That's for Matt. Also Computershare, BetaShares Global Agricultural Companies ETF. That's for Rosie. Greg's asked for DDH1, which I don't know anything about, so looking forward to hearing about that, and Sigma Healthcare SIG. My guests in studio, Jim Bailu from Tribeca Investment Partners and Adam Dawes from Shaw and Partners. Okay, guys, let's get cracking. Let's start with Woodside. And Matt writes in, what a special group of people you are all. Quick question on Woodside Energy. We'll soon see. Late last year, it was Adam Dawes himself said he put a buy on this stock, said that it was a good company. Now, you've been proven right, haven't you, Adam?
Let's stop there.
I know.
Stop there. Shut
Oil
the show.
price,
Shut
obviously
the show. We don't need
looking
to do
pretty
anymore.
good. But he's saying, is it a buy, hold, or sell now? I mean, keeping in mind the dividend yield, keeping in mind, I've been told, the likelihood of cash being returned to shareholders. These results in August, you've got to think will be good.
Yeah.
Would you buy it now, though?
Okay, so there's a couple of moving parts, and thank you very much, Matt, for those lovely words of how I got it right. Not often happens, but anyway, look, I think overall we have to take a bit of a broader view here. Do you think the Russia-Ukraine situation is going to get worked out in the next 3 months, the next 6 months, the next year? Potentially the next year it might get sorted out, but certainly not in the next 3 months. So I think that Woodside is still looking very attractive at these levels. However, there's going to be this massive integration now that they've got with this oil and gas asset that they've just bought from BHP, and that is going to take some time to really sort of work through, get some indigestion problems going, and try and get some synergies out of that. That still remains to be seen if they can do that without tripping up anywhere, which might be a little bit difficult for this company because it's such a large asset going forward. If the oil price stays above $100, I'm really comfortable. We all do remember through the COVID period where oil went into negative, right? So basically it can happen like that. I think anything with a $30 in front of it, I think you'd definitely be looking to buy this. I think the reporting season is going to be good. The market's definitely behind it at the moment. And there's this case of also now a lot of shareholders, BHP shareholders, have got Woodside shares. Now, they're not probably natural shareholders, but that they would have got a small holding in their CHESS account. They would have potentially already sold that. That would have already now come out. So there's that extra pressure that would have been over the stock from when it first, I think it was June, somewhere around there, that stock came along. So yeah, that pressure's finished. So I think I'm okay with that as well. Pretty comfortable with Woodside. Oil price has to hold up, and I think if we see a result from Russia and Ukraine, oil price is going to come under $100, which means Woodside is going to come under some pressure. So I'd be careful. I think that's the barometer, what the oil price is going to do, but I think it's going to stay over $100, so I'm comfortable with a buy on Woodside.
Comfortable with a buy on Woodside, so you're not selling to cash in any of the gains that you've made?
No, because I've already topped up everybody from the BHP shareholders that had small ones, so I've topped them up to make it a more meaningful holding, 5% of clients' portfolios weightings. I think it's going to be a good reporting season. Woodside's been ex-growth now for many, many years, and now they're getting the growth because they've got this oil and gas asset. It's a great asset that they've brought in, and they are going to be cash positive. So I think the wind is behind their tail. I think that they're going to do okay. It's just all predicated on the oil price, and if the oil price starts to move lower, if Russia or Ukraine gets sorted out, then you get out.
That's a lot of disclaimer, Andrew. There's a lot of disclaimer.
Well, that's right. I got it right last time. I hope I'm going to get it right this time.
Look, that's the thing with investing in the share market, that you need to take calculated risk. And one of the big risks is that it's commodity company. So if the oil price goes down, it will go down, no matter how good it is. It's actually got a great asset from BHP, and it's just the price moves, it moves. Now, our view in terms of the oil, we do think it will be reasonably supported, because even if we have Russia, Ukraine sorted out, the sanction isn't likely to go away. That's very hard to see that get removed. Now, Europe is working its way out on how to deal with it, and they will find ways to deal with it, right? Just means structurally a little bit more support for the oil price for the time being. And given the volatility also in the oil prices and the ESG focus and everything, you won't have any more new investment around the world, additional shale and all of these. Shale is not happening. In the old days, the shale used to switch on just like that, and we haven't seen any. The rig count hasn't improved. So there's no supply coming out while demand is constrained. And then China's coming on, don't forget. I know the rest of the world may slow somewhat, but everyone needs to take that one international trip. So the jet fuel demand, which used to be the swing factor, is going to be very strong. China's coming back up. You've got sanctions in place, and then you've got no supply coming on. So that probably means that oil prices, yes, it may briefly dip below 100 because of tactical and all of that. It will come back up. So so it's very hard to see that coming off. So on that basis, I do think Woodside is probably one of the best one. Great assets, great cash flow, and underperform a little bit at the moment because people worry about growth and things. I think you take a 12-month view, I think we'll do fine.
So at this price, $31 roundabout there.
Absolutely, yeah.
It's a buy. We've got a couple of them, folks. So that's for you. Matt, thanks for keeping track of the performance of the recommendations of our guests as well. Oh, trust me, I get emails when they're not right.
When they're not right,
Computershare for Jonah, CPU. Computershare does benefit when there is a interest rate environment that is on the upward swing, and that's what we're seeing here and around the world, Junbei.
Absolutely. Based on, if you put in the current bond yield curve, that which is the expectations for future interest rate, you put that into Computershare's earnings expectations, despite enormous amount of upgrade that took place in the last 6 months, earning will still be 50% higher if everyone put the current spot rate in. And so, so the upgrade cycle is well and truly in for this company in the next 12 to 18 months. Is going to be very strong. Now, share price has outperformed a lot. So what that means is that people are capitalizing on that. People know this is coming through. So it's in the expectations, even though consensus analysts haven't upgraded earnings, but multiple is expanded. So if we have any stabilization in the bond yield, in the future interest rate increase, so we know with the rate increase is 50 basis point or 75 basis point. If at some point Fed start turning a little bit dovish, as in they we might pause for a little bit, this company will crater. It's not because earnings not going higher, earnings still will be upgraded. It's just that it's been such a safe haven in the current environment. It just outperformed everything else so much. For me, it's more of a neutral to a mild positive, because I think earnings still going higher. It's just you have to be mindful that there's a lot of money already parked there waiting for those upgrades to come through.
Yeah, I mean, the chart sort of says it all. Even though Computershare sometimes on down days for tech reflects the negative sentiment. Really, to Junbei's point, it's been largely one-way traffic for Computershare. People hook on to its qualities in the rising interest rate environment. So at $24.88, would you buy?
Yeah, it's a little bit tough up at these levels here. So how they reap the benefits from higher interest rates is that they get a lot of dividends that are held from people that don't have a bank account, are dead, all these kinds of things. And they're able to use that higher interest rates to reap that capital that they get out of that, or higher interest, and then put that back into the business. So hence why it's that sort of uptick in the interest rates going forward. But where the share price is at the moment, I think it's run too hard, and I totally agree with Junbei that over the next 6 months to 12 months, we're going to get some dovish kind of commentary from the Fed as well as our market saying, look, and I've even heard end of 2023 that interest rates are going to come off after. I mean, seriously, guys, we're just, we're going around and around in circles here. But that's what's going to happen. So, yeah, I'd be really cautious up here at these levels. If you hold it, definitely hold it, because it's been a fantastic business. I've got a lot of clients with a lot of Computershare, and I could sort of ring them and say, how about we think about selling some? No, this one's going to me with the graves, like CSL. I just can't get them to sell it, which is fine because it's done very, very well. But up 35% over the last 12 months, it's had a great run. I'd be cautious at these levels with fresh capital.
Because it is important to know when to sell as well.
Well, that's the only time you make money.
Yeah.
Yeah.
Yeah. But there's a reluctance, is there? You know,
there's a reluctance.
Even when you've got markets that are coming under this type of pressure?
Yeah, 100%. So someone asked me the other day, Endeavour, it's held up. It's you know, defied gravity. Really, it has. And I think it's a great stock. But you know, why is it defied gravity? Is its turn to, like Computershare, is its turn to have that, you know, that fall? But people get emotionally invested in these things, and from that, it's very, very difficult to get them to pry it.
Yeah, even if you think there's opportunities to take advantage of opportunities, you need cash.
Absolutely, and I think just remember the experience with Woolworth and Coles, you know, the staple space maybe 3 months ago, just before they were sold off. Everyone was hiding in the Woolworth and Coles thinking they've got pricing power, inflation's great for them, and all of that. And then, you know, the share price went through the roof. No one wants to sell it, even though the market was selling off, but they were still holding strong, and all of a sudden they realized actually it's consumer stock. All over US, they under enormous amount of pressure, passed through, people trading down and costs going through the roof, and people just realized actually, you know, and then the share price came through, it literally came down 10-15% straight away within the week. So, you know, a Computershare will have that kind of experience just because, you know, everyone's considering this is a safe haven, interest rate beneficiary, but banks, you know, 3 months ago everyone was sitting in banks, and then suddenly recession, oh God, sell banks, and banks went down 10-15% within a few days. So this will happen to this company. We just don't know at which point, but it's coming. So it's, you know, to me, it's you know, made a lot of money. You can certainly halve some of your positions and put into other things that's being sold off so much.
Yeah. Great chat, guys. Let's get on to number 8 on the list, though. And this is the BetaShares Global Agricultural Companies ETF. It's much quicker to just say food. That's its ticker, FOOD. This is for Rosie. So you already said that you like Elders.
Yeah.
Is that because of the way that Elders is run, that it is now a pretty lean, mean machine?
Yes.
Or is it that food thematic?
Well, it's definitely that food thematic. I definitely think that that's something that everybody should potentially have in their portfolio. But everybody asks me about GrainCorp, or they ask me about New Farm, or they ask me about other ag stocks, and they're all tied to their commodity price. Yeah, so if wheat goes up, GrainCorp goes up, Tassel, you know, all those kinds of things. So Elders is like the Macquarie Bank of the agricultural sector. It's got financial planning, it's got the machines, the property, all of that kind of stuff. So more diversified. You're not in one commodity, you're in this sort of beast that's a little bit better. There's a lot of instos out there that are saying that agriculture is as good as it's ever going to get right at the moment, because you've got a winter crop, you've got summer crop, you've got great water, you know, everything's moving in the right direction for it. But that train has sort of started to unwind a little bit as well. So for me, safety, Elders is a better business. But certainly looking at this food one, it's about 59% of it is in the US. So you've got to be a little bit careful about sort of how you want your geography situated. And certainly some of the big companies in there, I think they've got Monsanto, which is the big seed producer. They've got a lot of the chemicals and stuff that go into the food production versus the actual
When you think about everything that we've been sorry to interrupt, but we'll get back to it. But like, considering everything we've been talking about, food shortages, war in Ukraine, it's not performed that well.
Because it's the prices of soft commodities really unwind in the last few weeks, and despite, you know, current war in Ukraine and things, it's just people start worrying about the recession, and the whole entire space, even fertilizer space has really come off. So you know, you see that rapid sell-off in the last few weeks, really.
Sorry, Adam. So do you like what's under the hood in this one?
Well, talking about under the hood, 33% of it is in fertilizer and ag chemicals. Okay, so that shows you that's the New Farm businesses, that's those kinds of things. And then packaged and meats is about 25% of it. So it is food, and they're trying to give, I guess, a broad scope of fertilizers and meat and production and all those kinds of things. But yeah, I'd be just a little bit cautious. I like the idea of feeding the world. I think, you know, that it's actually absolutely a theme that will continue to go on, and I think that theme is a very good theme. However, with that sort of pullback, soft commodities coming off a bit, you know, we've seen that inflation story. It's now starting to unwind. I think you'd be okay just to sit out of this one for the moment. If we get some more unrest, if we get another spike in inflation, if it continues to go higher, potentially, then yeah, you could have a look at this one. But I'd prefer to stay in Australia. If you need the international exposure, food is probably the one to go for, the beta shares one. But I prefer Elders. I think that's a better run company, better business, and it's the Macquarie Bank of the ag sector.
No, I've never heard that before.
Yeah.
I'll remember that though, Adam. You're welcome. Thank you.
Yes.
What do you think? I mean, talk to Elders, but also talk to the food ETF.
Yeah, look, I think I agree with Adam that you always find the company, find the company you want to invest in rather than the ETF, because ETF give you, yes, diversify, but somebody else is running it for you, so you got to be comfortable in what they put into. So you need to do your homework. Whereas the overall food thematic, I think it is here to stay. The pullback is really provides buying opportunity, right? So we're talking to soft commodities come off and everything just based on that ETF prices. They come off to where before the war started. Now there's a few structural issues happening now because of the war and Ukraine's big supply of grain and a couple of other soft commodities. A lot of those plants are not being planted for next year, and also given how high the fertilizer prices was a few months ago, a lot of crop or farmers have talked about not putting in the crop this year because just not worthwhile. So if anything, I think in 12 months, next year this time, we'll be really talking about more shortages in terms of grain and things. So I actually think the prices, even though you'll see a short-term dip because of war and all of that, it will find its way back up again, just because it takes time. These things take lead time. You really should be looking at trying to have something in the portfolio that is, whether it's Elders or with GrainCorp, and GrainCorp has had great growing conditions, but you've got to have something in your portfolio that gives you that thematic exposure.
Could it be a Costa Group?
I think Costa Group is actually looking pretty good. Only thing at this point, I'm a little bit worried. So they do have a lot of debt. So right now, because the interest rate is going higher, you've got to start checking every company that has a lot of debt.
Yeah.
And the rains as well. I think the rains
affecting.
The mushrooms and strawberries. You could look at, dare I say it, but BHP it's sold its oil and gas, but moving into potash, right? And then they don't do anything like that without a 20 to 50 year view on what's going to happen. So they see food shortage happening. They see agriculture starting to slow down, and they see potash as a way to refertilise the soil, make it more agrable, and then from there it can continue on. So you could potentially look at a BHP for some kind of agricultural exposure.
Okay, well, let's go there. BHP, does that represent good value right now?
Are you asking for opinion? Yeah, absolutely.
Yeah.
I'll be absolutely buying into this result. They will have a buyback, and that will so well support the share price. And then the dividend yield will be something in the double digit. It will be incredible. This is you want to be in there.
Well, I won't go past the experts there. I'm going to say I agree. Yeah. I agree.
Yeah.
I think it's a great business. We'll do well.
Okay, it's just such an interesting time in markets. I wish we had all day, but let's get to, this company, DDH1. This is for Greg, saying he bought in, and I like the context, at around $1 per share, March 2022, so March of this year. But he's watched the price head south ever since. He reckons the fundamentals look good. He thinks it's well managed, trading below book value, net profits of nearly 20%, no debt, high dividend yield, forecast future earnings growth of more than 18% per year. Thank you, did it for me. Largest drilling fleet in Australia. And it's been acquisitive over the past couple of years. So he's saying, what am I missing? Is the commodity boom over already? Many people are questioning this. We've got fears of inflation. We have copper down 20%, the price in the last quarter. So is DDH1 a victim of that, or is there something else?
So a couple of things.
Go back to your mining services.
Yes, we're back to our mining services point. So a couple of things is that, especially in drill rigs, as we talked about, drill rig count really isn't growing. That's in the oil and gas space, but anywhere that drill rig count really isn't growing. Now these guys have got one of the largest fleets in Australia, but you always, when you're looking at a mining services company, you always look at the utilisation rate. And the utilisation rate is basically how much of, if they've got 10 rigs, 100 rigs, how many of those are being used at any one time. Now, DDH has got 73% utilisation at the moment, which means that 30% of its fleet, under 30% of its fleet is not being used. And that's probably why the share price hasn't been so fantastic over of late, because that utilisation rate should be closer to 90 to 95%. Plus also then they've got 4 segments of their drilling, and one of those segments is a directional drill, which is really quite complicated drilling, and that's about 63% of its revenue. So most mining companies like really simple drilling, which is going basically straight down for as far as they can go, pull out the core sample, send it off to the ALS labs to be looked at, and then they get an understanding of what's going on. But the directional drilling is obviously quite different and quite technical, and most mining companies don't like technical because that means there's extra costs. So if they're having to pull that kind of rig out, they're generally doing that once they've made an inferred resource or basically got their square and plugged lots of holes to find out what's going on, but then they need to do one more hole across or down hole to get a real quantification of what the actual resource is looking like. So it's not as much needed as potentially when you just got the normal rig that just punches holes into the ground.
I'm getting the feeling this is too hard basket for you.
It is because, one, the utilisation rate, two, that it is quite complex, and three, mining services companies have really not taken advantage of this cycle of the commodity boom. So it's a little bit left behind. So it's not one. So it's
trading at about 75 cents. Would you maybe even exit?
Yeah, the chart looked like it just
had a little bit of an uptick recently.
Yeah, recently. So potentially that is, Matt's, what was Greg saying? He was saying he got in at $1. So yeah, maybe wait a little bit longer, see if this little rally potentially has a little bit more steam with it. But yeah, for me, it's nothing that I put fresh money in.
But Jinbei, like every day we've got, explorers putting releases out to the ASX as long as my arm the list is. I mean, there's got to be a demand for this product.
Look, there is good demand for this product. Our small cap fund actually quite like this one. They feel the management is great, well-run business, great track record, all of that. Great balance sheet, all of that. Exactly what the viewer is saying. It's they really love it. Now it's being sold off mainly because mining service just really struggle. It just seems the entire mining service space in the last year or two just really failed to capitalize on that. The commodity boom. Partly because of staff and finding people, and partly because of some of the fresh mine, just miners are very careful with the capex, the new fresh capex they're spending. So to me, I don't have a strong preference for mining services. ARQ I like because big part of the business is the environmental side of things, and it's not super expensive. So this one, if the mining, which in my view, the commodity prices will come back as China reopen in the next 6 months. So this one potentially will do okay. It's not expensive and all of that, but it's not something I will put a hold on it. But it's not something I'll rush out and buy just because the cyclical component of its business, and if the utilization is only sitting at 70%, it's not great for mining services.
All right, so Greg, that's a view from both of our expert guests here. Good luck making your decision, and again, this is information only. It's not financial advice for your particular circumstances. Okay, so let's get to Sigma Healthcare for Tony. He's a long-term holder. He's considering selling. However, he's having second thoughts because the rally is looking okay. So any opinion on whether you should sell Sigma if you're a long-term holder? We'll get the chart up. So
I think if you're a long-term holder of this one, there's a lot of competition in this space. So these guys do pharmaceuticals, so they sell to a lot of hospitals. They move a lot of that kind of stuff, but they're also in the chemist space, and that's a really tough space. So let's just talk about the chemist space for a second. I mean, obviously Chemist Warehouse is the biggest, the baddest in the space, but they only have 10% market share, but they're over 50% of the volume, right? So that shows you that something that a small company like Chemist Warehouse is doing a pre-IPO round at the moment, and they're looking to IPO in the next 12 months. That would be something that you definitely put in the bottom drawer. But I think because of that volume that they do push through, I think you'd be careful with Terry Wright's, on all these other chemists that are going there. And then the second part of Sigma's business is all about selling those drugs or getting those drugs out to the hospitals and things like that. That's always a bit of a tough one as well. Hospitals are very much watching their bottom line as well. So look, for me, I prefer staying, I guess, in the healthcare space, but not in the pharmaceutical space. So I guess a ResMed or a CSL is where I would gravitate to versus something like that. And we have seen some insider trading going on with Sigma as well. There was just last week, I think one of the executives was put in jail for insider trading. So little things like that just doesn't pass the smell test for me. So I'd be careful here. It'd be a no from me.
Thank you. What do you think about Sigma? given the context, he's held it for a really long time, was looking to sell, but now wondering if the charts are saying, hang on.
I think the charts is probably saying the resistance at 70 cents. Not that I read charts, but I do feel it is a very hard business.
Margins are very thin, right?
Very thin. And it's literally because they deliver pharmaceutical, and the agreement with the government is essentially saying, I'm not going to make money from delivering pharmaceutical because they have to be on-demand delivery to the most remote places, and a pharmacy can call them, once a day. They have to deliver once a day, and they have to do it whether it's profitable or not. That's across every mandated category on the government list. So that's a loss-making business, and what they're hoping to make money is by selling everything else. The front, they call it the front of pharmacy stuff, and that's why previously they wanted to merge, get bigger and better, right? And Chemist Warehouse has done very well by doing so, selling the front of the store things, pharmaceutical, other stuff, not pharmaceutical. So this company, very thin margin, and then the M&A went through the market. I think API was bought. API had a great brand. Price line is very different. It's got that feminine, female appeal. It's got that sister club. So that was very attractive to a buyer. Whereas Sigma just didn't have it, and Sigma used to supply, actually still supply the back office for Chemist Warehouse. That's after a few years of fighting. So that's it's just a very tough business. I really wouldn't be holding it, and it's going nowhere. The new CEO is going through a bit of challenges as well. Mark Cooper used to run this business like his own private business. After he left, you've got a new management team who probably will do okay, but we're just not sure where some of the costs and things might come from. So it's just too hard.
Just too hard basket. There you go, Tony. I hope that helps you make your decision regardless. Look, I said if we had time that we could just chat quickly about gold, because the gold miners have been hammered. I mean, Evolution Mining was sold down by 20% on Monday, and then the next day as well, after some broker downgrades, I think, came through. But I know you like the big gold miners, or you have in the past. So again, is this one of those opportunities that are just sort of screaming, at investors? Yeah,
look, so I think that's after the earnings downgrade. So as I mentioned before, all the gold miners will have very tough production reports. So we saw, Northern Stars and everything come off. For me, I always believe gold has a place in the portfolio. I keep it reasonably neutral-ish, but, gold is something that people little while ago was saying, let's sell gold because the inflation is picking up and everything. But don't forget, gold used to be used as inflation hedge and as a recession hedge. So, during the heydays, right? So right now, and then a few months ago, people were saying, we don't need gold, we got Bitcoin. So that's the new hedge, but it's not. So, I actually always believe gold has a place in your portfolio. Don't worry about, this people's short-term view here and there. They're very volatile, don't have big positions, but stay with the big miners. Just have some position in
the reason why I think Evolution got hit harder than the rest of them is that they had their confession session, and yes, they came out and said, okay, we're going to have, we're downgrading 2 to 3%, but then they took it a step further and said, financial year 2023 and 24, we're reducing our numbers as well. And I think that's why they got hit a little bit harder than potentially the rest. But staying here in the big space, Newcrest for me, Evolution, Northern Star, they're all fantastic. I just really quite comfortable with gold. I prefer the GOLD, which is the ETF, which is just the commodity, because then you overlay everything else with risk on company, risk this, risk that, someone's going to die, those kinds of things. So yeah, the GOLD, I think 5% in anybody's portfolio, because I do think it is going to be a good hedge against inflation. It still has a $10 trillion market cap. It ain't going anywhere. Bitcoin, on the other hand, is already halved and not halved again. And I think everyone investors in those ones are licking their wounds a little bit and saying, okay, where can we go next? So I think gold should do well. But it's really interesting to see how they've all started to come out at the same time. And labour shortages is a big key. COVID, weather, the list goes on. So still comfortable with the gold space.
Got it. Thank you. Let's just sum up what we've learned in this past half hour. Woodside, it is a buy for both of my guests. I'm very comfortable if it's got a 3 in front of it, so in the 30s. And Junbei gave us her thesis on oil, and she reckons that it will remain elevated. The price will remain elevated. Computershare, too expensive for Adam to buy right now. Junbei's a bit neutral on it, but she does say that there will be a sell-off coming if we get any sort of a whiff of dovishness coming from central bankers. Now, the food ETF, little cautious on that. Adam, as you heard, really does prefer elders. Junbei agrees that you want to find the company to invest in rather than the ETF, so she's not recommending the food ETF. DDH, it's a hold for Junbei. It's in the too hard basket for Adam. Look, the final company on the list was Sigma Healthcare, and it was a resounding no, really, from both of our guests to buy in, and I think they were leaning toward perhaps taking some profits if you've made them. Look, that is the program. Guys, thank you so much for coming in. Junbei Liu from Tribeca Investment Partners, always a pleasure.
Thank you for
having me. Have a good weekend. And Adam Dawes, Dawsy from Shaw Partners.
Absolutely.
Thank you.
You're welcome.
And thank you for watching. Stay with us though, because coming up next, we've got the small caps. Also, you can check out the portfolio at ausbiz.co/portfolio. We'll be back in just a tick.